Good morning, good afternoon, good evening, depending upon which part of the world you are attending this session from. Welcome to this session with ICICI Bank and ICICI Securities, my colleague Pankaj, who heads research at ICICI Direct, Samir, who is head of our economic research group, and I'm Nilesh Munda, I am head for private banking in India. Before I invite our speakers to share their thoughts and insights on this maybe topical subject, what's happening in market, and we'll talk about it as we go forward. Let me quickly reiterate that sending money to India is now much more convenient, seamless with our M2O and SmartWire platforms. Making payments in India can now also be done using UPI to international mobile numbers too, of course, subject to certain conditions. To know more, you can visit our website and navigate to our NRI Edge for detailed information. Thank you. With that, maybe we'll jump into core of our discussion. The first half, maybe we'll talk more about what's happening in the global economic context, which is essentially shaping up the market dynamics globally and in India. And as we move forward, we'll kind of talk more about what's happening in India and what are the specific opportunities that one could look at from an Indian perspective as we go forward. So first, over to you, Samir. Uh, Obviously, we have heightened tariff-related uncertainty, and as we were joking before the conversation that we had, I mean, it all depends upon what kind of tweet or comment that you get on X every day night, and that determines the course of the market in US nowadays. Anyways, so when we started November, December post Trump 2.0, the whole thing was all about US exceptionalism and make America great again because of various things, including deregulation and fiscal boost and things like those. Now it is altogether a different thing, wherein, as it looks like that the tariff-related uncertainty that has been induced seemingly has begun to hurt the outlook towards U.S. economy itself. And that's of importance because US is 25% of the global GDP and 70% of global equity market cap. So first, my question is, what are the probabilities of a significant slowdown in US? Something that maybe equity markets and bond markets have already started to kind of recognize, if not yet conclude. Yeah.
Thank you, Nilesh, and a very warm welcome to all the participants who've taken out time today to join us. Welcome to the call. In terms of, it's a very interesting question, Nilesh, and I think uh, when initially the president was elected and compared to where we are today, there has been a significant, movement on certain key topics, which were so-called campaign promises. One of them, obviously, was tariff or Make America Great Again, and part of it was how tariffs can actually drive higher economic growth. And we had seen a semblance of that building up in, the previous administration as well when he was leading it. But this time around, I think first of all they've started a lot earlier than the last time around, and of course consequences have been looking to be much larger because the breadth and the width or the entire spectrum which is being targeted is very wide. So as we recall last time around, uh, sorry, the president started with blanket tariffs, but then there were carve outs. So hopefully there will be carve outs this time as well. But uh, if you assume no carve outs or a lack of negotiations, then you are looking at a significant drawdown in terms of economic growth as well as for markets. So just to give you, an instance in which there are two parts to the U.S. exceptionalism. One is the fact that the U.S. has been actually post the pandemic maintained a fiscal deficit of close to or more than 6% of GDP. And it can afford to do that because it also has a reserve currency. Now, if you bring in tariffs into that, it actually alters the picture somewhat. So you'll have a situation in which tariff-led retaliation will not make the US economy as strong as it was earlier. So just to give you an instance, yesterday the Fed released its dot plot, and it has significantly revised the 2025 and 26 growth forecast. Particularly 2025 growth forecast has been sorry, has been revised by almost 40 basis points. So growth is now estimated at 1.7% from 2.1, and it's a significant slowdown from 2024 when growth was at 2.8%. So it's more than a 1% slowdown. Now, what is going to drive, sorry, this slowdown is essentially consumption. So you're already seeing signs of much weaker consumption in the US. You are looking at much weaker consumer confidence, and you are looking at much higher inflation expectations. So all of that put together, when Doge is also looking at much fewer jobs in terms of federal hiring. So, sorry, you should look at an overall situation in which the job market is weaker. Inflation is much higher because of tariffs. Our estimates suggest that inflation could be 50, 60 basis points higher from the baseline. So you have higher inflation, you have weaker wages or wage growth. And sorry, give me a second. So sorry about it. And overall, you have, weaker wages, you have lower consumption, you have fewer jobs. All of that, portends a weak economy and weaker equity markets. This is not priced in, clearly, Nalesh. What is priced in is somewhat slower economy, and growth picks up after a couple of months. Sorry, what is not priced in also is what the president is going to do in terms of corporate taxes. So if corporate taxes are cut, then equity markets get another lease of life. But it will also lead to higher fiscal deficit, which is any which way at 6% plus. So interest rates are unlikely to come down, and Fed will have limited room to cut rates. We believe the Fed cuts rates by 50 basis points this year and next year, and the economy chuggles along. So the base case is the US grows around about 1.7, 1.8% this year. It avoids a recession, and the markets go down a little bit, but then pick up later in the year. And the Fed does the needful in terms of cutting rates because growth comes down.
Okay, thanks. Now, while you get some hot water for yourself, your throat seems to need one. Maybe I'll move to Pankaj towards you. As far as these tariffs are concerned, do you think, Pankaj, that there is any risk to India per se? Maybe I'll go back to the other part of the global equation, but I think since we're talking about tariffs, maybe it will be good to kind of cover what's the view as far as India is concerned.
So, hi, Nilesh. I think one big issue which Samir also highlighted is that when a big economy like US is engaged in a tariff war with a big country like China, and together these are the two biggest economies. Obviously, it has implications for global growth and inflation, and which obviously will have repercussions for Indian markets as well. Now, coming to some of the sector specific, for example, IT is one of the big sectors. 50% of the revenues of Indian IT companies is derived from US. Now, most of the IT stocks are at 52-week lows, largely again coming from the perspective that IT tier one companies were expected to grow at 5%, 5.5% dollar revenue growth, which was expected to improve 100 to 150 bips every year. Now, with the US facing or likely to face challenges on the growth front, some of these stocks have started to price in lower recovery. So IT is clearly sort of getting impacted from that perspective, and it will have implications for us in terms of consumption. We have seen that pockets of real estate doing well where IT is sort of based. Another sector is pharma. Pharma overall exports to US has been about $8 billion. Now, in case if there are some tariffs which are imposed, then it is going to lead to unsustainable margins, and eventually it is going to force Indian pharma companies to pass on the prices. Now, there are no major alternatives for these generic medicines to be produced somewhere else. A case in point is that when you look at a company like Lupin highlighted that if they have to produce 1,000 oral tablets, it is going to cost about $5 to $6 in India, whereas in US it is going to cost 35 to $40. But what it does is that it overall pushes back the sentiment on the capex side. Similarly, while everything is not negative, our sense is that defense is one sector which can sort of benefit from better ties with US. US has already offered one of the fifth generation aircraft to India. Along with that, we are also looking to source a lot of engines for our fourth and fifth generation aircraft. Similarly, power is another sector where a lot of contribution can come in from US, especially in terms of technology. But since we are a sort of a more of a domestic driven economy, the overall implications for us is less. See, the another factor is the liquidity aspect. Last 6 months, FIs have sold about $26 billion. Now, in case if the US does very well, which is what has been the case or has been looked like, we have seen foreign flows going to US. Now, the sense is that if US does very bad, then there is a challenge that the flows can still sort of go back to some of the lesser riskier assets, and which could have implications for market in terms of correction. So, like Samir highlighted, a better scenario would be that US experiences lesser slowdown and does not really disrupt the overall economy. But overall, we are very well placed compared to most of the global economies from a tariff-related disruption perspective.
Yeah, so I think both of you are kind of alluding to some bit of slowdown, and some bit of slowdown in US is good. And maybe going back to Samir, I think in the global context, and which has linkages to India, and maybe you can be brief considering that. So, do you think that dollar has peaked for now?
Well, again, yeah, given the backdrop and the way the economic backdrop has changed, particularly in case of Europe and China, it seems that the dollar index or the dollar has peaked for now. I think the entire trade was driven by the fact that the U.S. economy or the U.S. was a source of strength. It only did not have the best technology in terms of AI, but it also had the best defense, support to NATO. It was the reserve currency of the world, and growth in US was superlative compared to other parts of the world. Now, that was the situation pre-September or October. Now, when you are sitting in February or January or March, you realize that actually growth in US is going to slow down significantly. And after 15 or almost 17 years, actually, Germany has passed a bill in its parliament which has taken away the debt brake. So the German fiscal deficit was supposed to be capped at 0.35% of GDP. Now they have infused almost 0.5% of GDP on an annual basis for infrastructure. In addition, you'll have additional defense spending. And Europe is also looking at extra spending for defense under its Rearm Europe program. So Europe looks very interesting. Incidentally, the European market, which is DAX, led by Germany, is the best performing market this year. Then you have China, the DeepSeek, which was again a positive supply shock for China. Much cheaper AI model has led to a complete turnaround in its technology sector. The president itself is also fairly more favorable to the to business sector, particularly for higher engineering or advanced technology. All of that put together shows that growth in other parts of the world is picking up when America is actually raising tariffs and disrupting its own growth, as is the case with growth in other parts of the world. Now, interestingly, Nilesh, both Europe and China, their reliance on America as a market for exports as a percent of their GDP is around 2.5, or even for China, it's even less than that. So the impact of higher tariffs on Europe and China will be there, but not directly. It will be indirectly because the world economy slows down. So in that context, of course, the dollar index has obviously peaked because growth is slowing down and other parts of the world are looking better. They are more insulated. So those currencies are benefiting. And that is why euro has almost, when it was looking like settling at parity, is actually moved closer to 108, 109. And we believe it has more legroom in the remaining part of the year to go even higher, probably to 112 and then 115 levels. So dollar index has peaked in our view. It comes down to around 100. But this is all the base case as we spoke about and Pankaj spoke about when there is no recession or no deep recession, just a minor slowdown. If there is a larger slowdown or a deeper recession, then the dollar index actually goes off because of risk off.
So for the benefit of our viewers, I mean, when we talk about, I mean, it's a kind of a jargon that dollar index is essentially nothing but a weighted average of various currencies across weights. And when dollar moves up, which means other currencies on a relative basis are falling down and vice versa. So dollar to the extent becomes important for us because if dollar goes up, which means maybe all other currencies are falling. And now that, Samir is concluding that dollar index has peaked, which means other currencies generally won't have that kind of pressure against dollar. And to that extent, INR should be fine, which I'll come to as we go forward. Quickly, one more thing when we're talking about, and you touched about Europe, so Europe and US maybe. One side we are saying that, there is a resurgence in Europe. The other side we are discussing whether there's a slowdown in US. Now, one point is maybe you can say a bit of conspiracy theory. The incessant rise in gold prices, all the way much above the fair value or cost of production, or let's say, for example, delinking with the models with respect to interest rates or dollar index itself. Now, this decoupling is really perplexing. So there's a view that maybe dollar is saying or dollar market is saying that look, either US goes through a very deep recession which causes interest rates and bond yields to fall, or that dollar is flawed and therefore dollar can fall substantially. Well, of course. So you tell us what you think. What gold is telling us.
Well, interesting, very interesting. In terms of gold, you're right. Ideally, historically, what we have seen that it used to be related with the dollar index, which in itself was related with how the interest rate differentials and growth differentials between different countries will play out. Uh, but what has happened in 2022, once the war broke out, what we saw that Russia could retain its dollar or sorry, gold reserves, but it lost its dollar reserves. The dollars which were around about, I think, $300 odd billion, which were parked outside in US treasuries or other currencies or other deposits with other central banks across the world, were impounded. But gold, which was with the Russian central bank in Moscow, was not. So it, it led to a situation, or it has led to a situation in which many central banks now are buying gold as a diversification tool or a hedge against any geopolitical event. So, all central banks put together are now approximately buying 1,000 tons of gold a month or a year on an annual basis. This number couple of years back was half of that amount. So number one is that the demand for gold has gone up. The jewelry demand globally is stable over the last decade or so at 2,000 tons. That has not moved. The third element which has changed over the last couple of months is the investment demand. As prices are going up, investment demand has also picked up. Last month, interestingly, ETF flows at $10 billion were one of the highest, I think, in the last 3 years. So these are the mechanics which are moving. But in terms of, is the dollar telling us what is happening? Yes, Nilesh, it is telling us something. What it is telling us is that the the uncertainty on tariff is what is driving not only dollar but even copper prices higher, aluminum prices higher. And why is that? A lot of physical gold, which was available in London, even copper and LME, uh, has actually moved to COMEX in America. So there is a physical transfer of gold that is happening from London into New York and Chicago and other bourses, and that is leading to a premium or a spread in US over the European rates or London market rates. And that is what is driving prices higher. Now, what happens once the tariff uncertainty goes over, is done away with in the next couple of months? You should see ideally, prices coming back to fundamental levels and not being artificially inflated because of this uncertainty.
Yeah. Well, I kind of obviously agree. Um Now, quickly, the cost of capital aspect as far as US is concerned, bond yields have fallen, and US bond yields determine as to its kind of global risk-free rate. It's fallen from 4.8 when there was an expectation that it could kind of very well cross 5 odd percent. It's now like 4.3, 4.2%. Do you think it is something which has value and one should continue to hold it, and that these bond yields could kind of continue to slide down maybe 50, 70 basis points or so, or you think that the room is much lower? The reason being, if this goes down, probably it helps other markets, including currencies globally.
So actually, Nilesh, again, historically, both equity markets and bond yields move inversely. I mean, whenever there's a slowdown, yields likely to come down, and stock prices also come down. But yields coming down means bond prices are going up. Uh, Only recently this correlation broke down when equity markets were going up and so were the bond yields. But now I think we're back to brass tacks economics, or much more orthodox economics going forward, in which you should see a situation in which the slowdown in the US economy implies equity markets or earnings being lower, consumer confidence being lower because of these tariffs and inflation expectations, and actual inflation picking up, which will hurt purchasing power of the consumer. But at the same time, it also opens up room for the Fed to cut rates. U.S. in 10-year yield actually, uh, if you see the term premium of around about 40, 50 basis points, and we do expect two rate cuts by the Fed this year and two next year. So a 100 basis points decline implies the Fed rate settles between three quarter and 3.5%. So 40, 50 basis points premium implies that the 10-year actually settles at around about 375, 370. So what it implies net is that there is at least maybe or around 50 basis points room for the 10-year to come down. So the shorter end USD 1 year or thereabouts, so 6 months comes down by around about 100 basis points. So there could be, or there's likely to be a steepening bias of the curve. But what we do see is that there is significant headroom for interest rates to come down. So one should be actually holding on to those positions or maybe even adding, because you should see interest rates coming down in America as growth comes down.
So yeah, I think the best part about this whole conversation is that maybe a somberish view as far as US is concerned, and a mild somber view with respect to US across all aspects. Probably what I kind of get take away is that it's generally going to be okay for the world, because it kind of keeps that pressure off of foreign outflows or foreign flows going back, and dollar appreciating, and therefore the only game in town being US, which no longer seems to be the case, luckily. And I guess maybe as we discuss, I mean, Pankaj, in Indian context, maybe the market seem to be kind of rejoicing this whole move over last 10 odd days. So you kind of spoke about it, but mm, and last 2 days, FIs have kind of bought us after a very long time some fresh buying, as it seems. I hope there's no block, no promoter sale or anything of that sort in the data, but What do you think is the situation as far as FIIs are concerned? I mean, five, like you said, 26, $27 billion of outflows, which is large. Um, do you think that it's kind of done by and large in the situation that we are in?
So, Nilesh, see, equity markets again depends on a lot of factors. So, largely from a medium to long term perspective, it's a function of one, corporate earnings growth. The other one is the macroeconomic factors, and third one is valuation. On the corporate earnings growth, the selling started from the September onwards. And what we have seen is that the corporate earnings had sort of come down. Nifty EPS is expected to grow at 4-5 odd percent. And this is more to do with the fact that we had a lot of state elections, and that led to sort of a slowdown in the overall corporate earnings. On top of it, some of the commodities like say steel is at a 4-year low, cement was at 1-year low. So all that sort of contributed to muted earning growth. So when Indian markets are trading at say somewhere about 21, 22 times on a forward basis, on top of it you get earning growth of 5%. So the China market looked very attractive, and which is where the initial flows went to. And subsequent to that, what happened from Jan Feb onwards is again the US market has started to look attractive with Trump coming in. Now, coming back again domestically, our sense is that next year, FY26 and FY27, we are going to see low teen kind of or 13-14% kind of earning growth. The GDP growth rate has bounced back, and the expectation is that you will see a growth rate of around 6.5% for the next 1 or 2 years, even longish as well. And we have seen Nifty correcting by about 15 odd percent from the top. Now, so from a valuation perspective, now it is trading at about 17.5 times on a forward basis, which is very much within the historical comfort range. And while yes, FIs have been sort of selling, and like Samir also highlighted, US is not the only attractive opportunity now. Also, with the tariff intensity or tariff war intensity sort of going up, there are challenges with US growth as well, and we have seen ample examples of US market or stocks correcting. With that in perspective, yes, some bit of an inflow has definitely got revived, but I wouldn't read too much into it at this point in time because you have FTSE rebalancing also. So that might have also played a part. But having said that, the domestic flows have been good. And I think if since our overall earnings are taking shape or are getting sort of normalized, our sense is that the market returns also will be in line with the overall earning growth. And macroeconomic factors have been absolutely fine. Currency looks like has stabilized. Crude oil prices are already quite low or attractive for us. And so it's a matter of time before FIs make a big comeback, and which is why we feel that all ingredients are in place for markets to sort of do well from here on, except for the interim volatility, which will get, which no one knows in terms of what kind of implications these tariffs will have in the near term or probably medium term.
And so what you're saying is that things are getting better. Earlier, it was excessive valuation and now fair valuation. And with the view on US turning somber, as we discussed earlier, with a lot of FI selling already happening, things improving at the margin, Indian equities, for example, or for that matter, look decent from a backdrop point of view after this correction, as well as, and maybe on this point, maybe I'll kind of invite Samir to talk about what is his view with respect to USD INR, because for international investors who are coming in India, there has been like heightened concern about rupee. I'm glad that it has hardly fallen, or like for that matter, touchwood. I mean, the volatility has been one of the lowest amongst various emerging market currencies. It's kind of retraced back. So, what's your outlook? Should one be still concerned about a significant rupee devaluation?
Not anymore. Not anymore. I think there's a significant turn of events, and it's actually, and both the sides are positive. Number one, the dollar index is actually retreating, so there is less pressure on emerging market currencies to depreciate. Though euro is likely to be the biggest beneficiary of this trade, but at the margin, the pressure on emerging markets comes down. So that's very positive. That's point number one. Point number two is fundamentally the rupee, which was overvalued to the extent of approximately 8%. Most of that overvaluation has got corrected. Now, as you correctly said, that rupee has not fallen that much. Even it fell a lot more, and then it is appreciated. Still, the last month's RER number, which is a way to measure the valuation of the INR or currency, any currency, has actually settled at 102.4. This at one point was closer to 108. So approximately 6 percentage points or thereabouts of the overvaluation has got corrected. Rupee has not depreciated to that extent simply because other currencies have appreciated. So on a relative basis, the rupee looks a lot more attractive now. That's the second part. The third part, apart from valuations, is the fundamentals of the external account, which drive the inflow and outflow of dollars. Now, uh, given the last month's trade deficit number, we have actually marked down India's current account deficit significantly lower from our earlier estimate. Now we're looking at 0.7% of GDP, around 25, $26 billion this year. Even next year, this number remains on an absolute basis closer to this number. So it could be even lower at 0.6% of GDP or thereabouts. And why is that happening? Because services exports out of India led by GCCs are holding up. We had actually a current account surplus in the last month, wherein the overall inflow from services account was more than $18 billion and outflow on account of the goods trade was 14 billion. So net you had a $4 billion surplus, plus you have remittances, but there is an investment outflow also because of interest payments on debt. But overall, we are looking at a significant current account surplus in this last quarter. And that implies that fundamentally there is less pressure on the rupee to depreciate simply because the inflows and outflows are much better matched. The other part is that FPI outflows, as you also spoke about, which have been significantly high, I have seen a reversal in the last few days. So from the FPI front, also there is much less pressure on the rupee to depreciate. So when you put all these, things together one by one, what you get a sense is that perhaps the worst for the currency has gotten over. What is the challenge going forward? Number one is the reciprocal tariffs that may come on 2nd of April or after that, depending on how Washington and New Delhi things pan out. But fundamentally, even if that's a negative shock for temporary reason or basis, we do expect on a fundamental basis, given what has happened to dollar index and EMs, we believe the worst is behind. Rupee settles around 86. RBI will be looking at building reserves, so it doesn't appreciate much, in our opinion. And uh, over the medium term, should the rupee see a significant appreciation? We don't think so. Why? Simply because inflation in India has come down now recently, and his outlook is very positive, around 4%. But still, China is deflating. America inflation, even if it goes up, settles around 3%. Europe will be around 1.5%. So India's inflation levels will still be somewhat higher than its trading partners. So there is a natural depreciation bias in the rupee, but it will be much lower given that fundamentals are very strong. So you should expect, 1.5% kind of depreciation on an annualized basis, or maybe 2% at worst. And that number implies that, over the course of the medium term or the next year, the rupee settles around 87, 88 is our base case, valuation number.
So, for the benefit of our viewers, RER is real effective exchange rate, which, I mean, again, maybe de-jargonizing a bit. And base being 100, it measures whether rupee is overvalued by 8%, 10%, 2%, or undervalued. Anyway, so what Samir, you are concluding is I think the worst of the volatility and overvaluation is done away with, and macro factors seemingly are now aligned for rupee to have I mean, a modest downward, gradual, less volatile journey as we go forward, and nothing to worry fundamentally. Um Pankaj, I'm taking a question here with respect to the forward-looking aspect of Indian equities. there's one aspect that we need to discuss about the Indian economy, which I'll come to, Samir. There's something called as this lake theory, I mean, which is being spoken about by certain commentators in public media. Rather, one commentator per se that there is finiteness of return in a particular period, and once that return is delivered, so let's say, for example, 5 years have been very good for Indian equities. Then for 1, 2, 3 years, it can kind of take a little while for the lake to fill up before it starts flowing again, which is returns to come in. So, how do you look at it in context of this whole lake theory? It's a question which has come, and I found it interesting to pick it up at this point in time. I guess Pankaj, Pank, yeah, no problem. So, Samir, I think this is a point which I thought it was very relevant. So, while we have discussed the concurrent aspect, do you think the economic part, which Pankaj actually spoke about, that has kind of fallen in shape, and the economic deterioration that we had seen, a cyclical deterioration that we had seen, let's say 6 months back or so, now is decisively turning for the positive?
No, I agree, actually, Dinesh. India's growth slowdown has clearly bottomed out. If you see this year, what has happened, Q1 was okay, but spending by the center was down big time in Q1. It was, I think, down by a third because we are looking at an election. Then, sorry, in Q2, it picked up somewhat, but still spending was down by 15 odd percent in H1 overall. Then you had an abnormal monsoon in which very heavy rainfall in the month of August and September, much higher than normal levels. That also disrupted activity. And all of that put together led to a very vicious slowdown in earnings as well. The third part was much weaker urban consumption. Why? Because wage growth in India, which was running at 15 to 20%, suddenly deaccelerated because of lower wage hikes in the IT sector as well, and lower hiring in the IT sector, where a lot of hiring had happened earlier for growth purposes. With sorry, so US slowing down, that was not required. So all of that put together led to quite a bit of slowdown. Growth bottomed out, I think, at 5.6% in the revised numbers, 5.4% earlier. But when the numbers were revised, they've come down at 5.6%. And since then, growth has actually picked up about 6%. This quarter also mixed indicators, but what we do see is a number of indicators are showing a pickup, be it electricity demand in the month of March, be it how the numbers are coming in terms of travel because of Mahakumbh, or for that matter, overall regulatory aspect from RBI, which has actually did a lot of regulatory tightening, but is actually losing it, a lot of it led by its liquidity measures, which it started in the month of January. This month itself, RBI has infused 2.5 lakh crores of durable liquidity, and we believe liquidity situation will continue to remain positive going forward, which is also growth accretive. At the same time, the center introduced a budget in which this is the last year of fiscal compression in FY26. They moved the anchor to debt to GDP from fiscal deficit, and we expect center to actually be much more, growth accretive by spending whatever revenue they get into the economy going forward. So all of that bodes very well because this year's slowdown is also driven by much bigger fiscal compression by the government in H1, which has continued. For states as well, which have seen a much bigger compression in capex spending. But that all is reverting now. You have the tax cuts which have been taken by the center, no fiscal compression going forward in FY27, then the pay commission announcement and the wages going up or pay going up. So all of that put together implies that growth picks up to 6.5% in FY26, then 6.7, and then 7 odd percent, which is the potential growth rate. And on top of that, inflation in India is finally coming down. RBI is like to cut rates in April as well, possibly change stance to accommodative, which implies liquidity remains in surplus. So we believe policy-induced growth accretive policies, as well as inflation coming down is very positive for India's growth backdrop going forward.
Okay. So, Pankaj, I guess the lake theory question spooked your
Yeah.
connection and you are reset. So, over to you on that part.
So I think couple of things, Nilesh. We have seen that India is taking a lot of structural measures. One, capex as a percentage of GDP is about 3% odd, and this has potential to go up given the fact that private sector is yet to sort of perform to its optimal level. And I think India needs to grow at 7% for the kind of young population to sort of find jobs. So from that perspective, I think we are solving or we are rightly moving in that direction. And see, most of this capex is directed towards core sectors like road and railways. So 50% of that capex is going towards that. On top of it, I think inflation has been sort of controlled for a very good period of time because of the inflation targeting framework by RBI. And I think the other thing to sort of look at is that when you look at from a overall growth perspective, I think one of the things which we are sort of clearly noticing is that for the first time there is a longevity of growth, or there is a comfort in terms of long-term growth what India can sort of deliver. And I think once we are sort of able to sort of control the inflation, the cost of capital is going to come down. And then what it does is that the ability of the corporates to sort of take risk goes up. So again, it has got a lot more structural benefit. On top of it, some of the core sectors, say for example, banking is one of the core sectors. Now, with the Insolvency Act sort of coming into picture, this is the first time we are seeing a change in the borrower's behavior. And also for a big sector like real estate, while China is struggling in terms of real estate in certain pockets, I think we have already gone through that cycle with RERA coming into picture. The industry is getting a lot more organized. And now, from a flow perspective, also, this is the first time we are seeing the domestic flows being quite resilient. And I'll give an example of US. So US had multi years of bull run largely because of the domestic flows and with stable growth. And I think India can achieve something of that sort as well, where growth can be sustained and even the returns also can be sustained over a longish period of time. Obviously, what will happen is that since valuations are on a slightly higher side, it is very much possible that your earning growth could be higher, whereas the pricing growth or price appreciation could be slightly lower to adjust for the multiples which are slightly rich in certain pockets. But in general, India is one of the few markets where double-digit returns are looking or are a good possibility to have.
Okay. Quickly, what are your sector views? I mean, what is it that you really like from in Indian context, and what is it that you really dislike? I think you spoke about the IT part earlier, which I presume is your tactical dislike. But what do you really like at this point in time?
Absolutely, Nilesh. So what I like is one, a big sector like banking and financial services. It's 40% of the index earnings, one third of the overall Nifty pie. Now, this sector is changing for sure. One, I think what we have seen is that there has been liquidity infusion by RBI. 25 bips kind of a rate cut. We have already seen 50 bips rate cut is on the horizon. Then they have certain reduction in the risk weightage to certain categories. Credit growth is expected to sort of normalize to 12 to 14 odd percent. And I think overall, besides that, our sense is that we will see a revival in the government capex. And so this is one of the few sectors where growth is good. Valuations are quite attractive from that perspective. The other sector which we like, and not only for 1 or 2 years, but longish, is the capital expenditure as a theme. Now, our sense is that for India to sort of do well, you need to grow at 7%, and that is only possible with higher capital expenditure. So capital expenditure is more of a necessity because you need to sort of provide jobs to a lot of young Indians. And for that, capex is very much required. 3% is what we are sort of achieving on a constant basis. And to give you one color, private sector capex used to be 4 times of what the government used to do somewhere in 2009, 2010. At this point in time, it is slightly less than what the central government capex has been, and we have got one of the best corporate balance sheets. So I think private sector capex or capex as a theme is expected to do very well. Now within that, we like capital goods. Defense is one of the sectors which can do well. Ordering is expected to sort of pick up. In fact, the defense secretary is highlighting that it could be double of last year. Then core sectors like say cement and steel is also what we are liking. Now, decarbonization is a very big theme. I mean, whether it is for auto, whether it is for a lot of sectors like say cement or steel, or even a sector like say, for example, telecom, we are definitely seeing a lot more higher data consumption. So demand for data centers, not only in India but globally, is fairly high. So power is one theme which we feel is going to be there for a good period of time. Consumption, we are selectively positive in something like say hotels and hospitals or selective autos. On top of it, I think one space what we like besides hospital and healthcare is the CRAM space. I think US can provide a lot of opportunity there. One, if the Biosecure Act gets passed, then there is always a perspective that US is going to sort of do more of sourcing from India, or India is going to help more on the contract research and manufacturing side. And then I think overall sense is that the biotech funding scenario is also expected to sort of improve. So that is another segment what we like. In terms of dislike, like I said, IT is definitely going to sort of struggle because we were expecting growth rate to sort of improve for the next 2-3 years. I think that has been pushed back with the volatility expected in US growth rate. So IT probably is not going to outperform the broader market. And I think FMCG is another segment. See, this segment did very well when most of the legs of the economy were not doing so well, because this was the only segment which was doing well. And in that process, the multiples or the valuations got rich. Now, there is a course correction happening, both in terms of growth and in terms of multiples. So overall sense is that this is another pocket which is going to sort of underperform.
Great. So I guess we've covered the international part, the impact on India, which is likely to be fairly modest, as I believe. Of course, subject to the reciprocal tariffs that Sami spoke about. The growth outlook, which is slightly getting better as we go forward, all the policies which kind of led to the cyclical slowdown are perhaps reversing. What's happening in US is also kind of leading to a favorable outlook on emerging market currencies in general and INR in particular, given also the current account situation, Sami, that you spoke about. One last thing about India before we end, and there are many things that Pankaj has spoken about in terms of what offer value. And I would request all of you to kind of have a look at the icsadirect.com site. When you log in, you will have many of these one-click portfolios across all these segments that Pankaj spoke about, which are already curated for you to kind of have a look at. Samir, I mean, in before we end, any quick take on RBI policy and where could you probably look at interest rates going down? And to that extent, is there a need for one to kind of lock in yields, maybe for 1-2 years, 3 years or so, because interest rates have already begun to get cut, maybe liquidity as it goes down, maybe, interest rates finally start to fall in 25, 26, right? So what's the view there?
So, Dinesh, what we believe is that RBI has already done one rate cut, and it started infusing liquidity somewhere around, end January, when it announced a series of liquidity measures. Actually, it started doing it in December itself with the CRR cut, and then followed up with even more liquidity measures in January end. And in March, it has followed it up with even more liquidity measures by announcing, approximately 1.5 lakh crores of OMOs and a buy-sell swap. Now, a large part of these liquidity measures were also have also been done to undo the FX intervention that it is doing. By that, what we mean is that whenever some of the foreigners were selling dollars, they required that dollar, and that dollar liquidity was provided by RBI. And the moment it happened, it led to impounding of the rupee liquidity, because to that extent, rupee liquidity went down. And so, from a surplus of 4.8 lakh crore somewhere in the beginning of the year, we saw a situation in which the core liquidity actually turned into a deficit in the month of December, and that's what led to RBI cutting CRR. And it was followed by even more outflows in January and a little bit in Feb, because of which RBI continued to infuse liquidity. But now the current liquidity infusion has ensured that durable liquidity remains in surplus for the foreseeable future, once the RBI dividend is also paid out to the government. So that implies that we are in a situation where easy liquidity policy, along with lower interest rates, implies that interest rates or yields in India are going to go down, both at the short end and the long end. Now, at the short end, we expect another 50 basis points of rate cut, first in April, and then another one we'll have to wait and see, depending on how global and domestic growth backdrop pans out. But overall, we expect 50 basis points of rate cuts, so yields to that extent come down, short end even more than long end. And given the term premium, we believe if the 10-year settles at 575, but term premium of 60-70 basis points implies somewhere around 6.4 is what it settles. If there is another rate cut or deeper rate cuts, depending on global and domestic growth situation, then the 10-year comes down. But we believe our base case is that it's the best time to lock in yields, because more rate cuts are expected, more liquidity is expected. So this is the best time to lock in higher yields.
Yeah, that's what it looked like. Many thanks, Samir and Pankaj. I go back towards the weekend quite excited about looking forward to the markets next week with the positive commentary that both of you have kind of shared with us. Thank you so much for your time. Thank you to all our participants who have taken time to kind of hear us out today, afternoon, morning, evening, as the case may be, from where you're logging in. And before you sign out, please take out some time to kind of give your feedback as we close down. Thank you and a very happy weekend.
Thank you.